If you look for the greatest investors all time on Google, you get Warren Buffett, Benjamin Graham, Peter Lynch and Sir John Templeton. They are for sure the most prominent and most copied investing minds. But have you ever heard about Bill Miller, Bill Ruane at Thorp or Nick Sleep? There are so many more successful masterminds in investing with their own investment strategy and methods. But how can we become aware of them, and much more important, how can we learn from them? There is this brilliant journalist from the UK now living with his family in the center of finance in New York City. William Green has written for many publications in the US and Europe, including Time, Fortune, Forbes, Fast Company, The New Yorker, The Spectator and The Economist. Over the last 25 years, he interviewed many of the world's best investors, exploring in depth the question of what qualities and insights enable them to achieve enduring success. William's new book, Richer, Wiser, Happier: How the World's Greatest Investors Win in Markets and Life, covers hundreds of hours of exclusive interviews with well-known and unknown masterminds of investing. Today we will ask William 5 questions on how to become a better investor by studying the greatest investing minds. So stay tuned and enjoy the ride. Welcome to our channel. Today I've got the honor to talk to William Green, the author of one of the most influential investment books these days, Richer, Wiser, Happier: How the World's Greatest Investors Win in Markets and Life. Thank you for having you on our show.
Alex, it's such a pleasure to be here with you. Thank you.
Your book is really remarkable. You are sharing hundreds of hours of interviewing the greatest investment minds ever. You are exploring in depth the question of what qualities and insights enable these minds to achieve enduring success. Therefore, our today's focus is on how to become a better investor by studying the greatest investing minds. But as a warm-up question, William, please let us know, after studying English literature at Oxford University and journalism at Columbia, how did you become one of the most rated investing journalists? What was your motivation to enter the finance industry, which is in general seen as a huge gambling place?
Yeah, it was a very unexpected outcome for me as well. I always assumed that I would be some kind of great novelist or something very literary and high-minded like that. And I came out of Oxford and I started writing screenplays and discovered that I wasn't very good at it. I was very young. I was only about 21. And then I started writing nonfiction for magazines. And that worked pretty quickly. And at about the same time, I guess in my mid-20s, so a little afterwards, I came into a little bit of money because my brother and I had owned an apartment together in London, and we sold the apartment. And so suddenly I had this pretty modest windfall, but it was enough that I needed to make sure that I invested it well. And so I had to figure out what to do with it. And so I started reading about investing and reading about funds. And so I did it in a fairly random way. I would read things like Burton Malkiel's book about random walk, and I would read all of these things about whatever the best funds were. And so I started to invest my own money, which I think it makes me different than a lot of people writing about investing and business, because I actually had skin in the game. I cared about this, and that makes a huge difference. And then because I was writing for magazines like Forbes and Fortune, I would actually go interview someone like, say, I invested in Marty Whitman's fund. I don't know if your listeners remember him. He was one of the great deans of value investing. And he was this old crotchety guy, really smart, really tough. And I invested in his fund. And then I would actually go interview him and write about him for Forbes. So it was kind of this amazing thing that you could interview the people you were fascinated by. And so then I went off, for example, to the Bahamas, and I interviewed Sir John Templeton. I spent a day with him. And he was this guy who was at the time just about to turn 87 and was probably the greatest international investor of the 20th century. And so I would be gathering these ideas from these people as I interviewed them. And then around 2000, in the midst of the tech and internet bubble, I was interviewing people like Bill Miller, who at the time, I think was about 10 years into his 15-year run of beating the market, 15 years running. And I think part of what happened to me is that I saw that people like Miller had extraordinary minds. And so initially, when I was writing about these guys, I thought, they're going to teach me how to become rich and it's going to be great. I'm going to become super wealthy myself because I'm going to figure out how to invest with these guys. And I think gradually, as I started to spend more time with Bill Miller and other legendary investors like that, I thought, these are really remarkable thinkers. They have extraordinary minds, and you can learn a lot from them, not just about how to invest better, but actually how to think better, and possibly even actually how to live more wisely, because they're so pragmatic and so thoughtful. And so my interest in the greatest investors has kind of deepened over the years. And I think that's really the basis for writing Richer, Wiser, Happier, is that I wanted to share all of these ideas that I'd learned really over hundreds of hours of interviewing these legendary investors over the last 25 years. So in a sense, it's my distillation of everything that I've learned, or at least the most important ideas that I've learned from them about how to invest better, how to think better, and actually how to live more wisely. So that's a long-winded way of answering your questions. But I think that sense that they provided this remarkable filter through which you could see the world is really important to me. It's initially, how do you become rich? And then gradually it's, actually, these guys are extraordinary thinkers, and you can learn a tremendous amount from them.
It's not just to get quick rich, it's just more to become a better of yourself, right?
Yeah, wiser, smarter, more rational, more pragmatic, less self-delusional, less dumb.
And happier.
Yeah. I mean, one of the things that I learned from Charlie Munger, who I interviewed for this book, who now is 96, 97 and a genius polymath, is just to be less stupid, to say, okay, it's really hard to be smart, but it's actually surprisingly easy not, just to avoid these really dumb mistakes that blow us up both in markets and life. That's a very beautiful idea that's tremendously pragmatic, both in investing and in life. And so those are the sort of ideas that fascinate me. That's something where it's one of the deep principles of life to say, okay, I don't have a huge IQ. I'm pretty smart, but I'm kind of scattered. My mind is all over the place. I'm not the most productive person. I have a lot of flaws. I'm pretty irrational. I'm too emotional. I'm a little fearful. There are going to be all these ways in which I'm likely to screw up as a thinker and as an investor. But if I can be systematically less stupid, applying Munger's approach, I'm going to have a better life and I'm going to have more success as an investor. So just to go through life and say, okay, what do stupid investors do? What do terrible investors do? Which is one of the questions that Munger would ask. He'll say, instead of saying, let me be a great investor, let me start by saying, well, how would I be a terrible investor? What does a terrible investor do? And then let me not do that. And so if you think about all of the dumb things that investors do, most of which I've done myself over the years, so I'm not being judgmental about it. We trade too often. We jump in and out of the market. We sell our winners too early. We assume that we know what the future holds, whereas the reality is we have no idea. If Buffett and Munger can't tell where the market's going, what chance do you and I have? So you have to be kind of humble about what you can know about the future. And most investors have very high expenses. They don't understand the investments that they own. So they're kind of setting themselves up for failure. So I think even a simple principle like that, like understanding that you want to be less stupid, systematically less stupid, is incredibly empowering. And that's what became really beautiful and exciting for me as I studied the greatest investors, is I started to realize, these things apply not only to investing, but to life. So Munger will say, let's apply this process of trying to be less stupid to life. So say, if I want to have a happy life, let me think first about what kind of behavior will guarantee that I have a miserable life. And then you think about that and they'll say, well, indulge in envy. If you indulge in envy, he describes it as the dumbest of the 7 deadly sins because it's not even fun. And so just knowing that sort of thing, that if I indulge in envy, it's going to stack the odds against me for having a happy life. Whereas if I start to say, let me appreciate all the gifts I've been given. What an amazing thing that you and I get to talk about these fascinating people, that I've got to spend my life interviewing these fascinating people. What an amazing thing that we live in countries that have the rule of law and where, we have our health and we have families and friends. Once you start to think that way, you're just stacking the odds in your favor to have a happier life. And so I think learning some of the basic principles of what works both in markets and life is incredibly empowering. And so that's what I'm trying to do with my writing is to distill the essence of what these very smart, very wise people have learned so that I can live by it myself, but also so I can share it with other people.
Yeah, that's so true. Thank you. So let's come to our first main question. In your book, you are referring to the greatest investors of all time, like you already mentioned, Sir John Templeton or Charlie Munger. You have chosen masterminds who are unique in their investing style and in life. You call them intellectual mavericks. What do you mean with this term and what makes them so special?
One of the things that I discovered, Alex, over many years of interviewing these people is that they're iconoclasts, mavericks, free thinkers, and they're not following the tribe. They're not following the crowd. And if you think about this in evolutionary terms, most of us find safety in the herd, right? We don't want to stand out. We don't want to be like the gazelle that's picked off by a wild animal. And so particularly in times of extreme stress, like a market plunging or COVID crisis or a depression or anything like that, or some kind of disaster, or also in moments where the market is going crazy and is surging, people get carried away, they join the crowd, and it becomes kind of infectious, the behavior of the crowd. And then there's this small group of people who are non-tribal, who don't follow the herd, who think for themselves and question everything. And the greatest investors are all like that. They're all super rational. They're for some weird psychological reason, some accident of upbringing or quirk of wiring, they don't have this need to find safety in the crowd. And I think there's something about this that appealed to me deeply as a writer. I mean, I'm a Jew who ended up going to the poshest schools in England, right? Schools like Eton and Oxford. I was surrounded by people like Boris Johnson and David Cameron, these, the people who became prime ministers, and they were from very posh backgrounds. My family was from, shtetls in Russia and Poland and Ukraine. And we got where we were through intelligence and hard work. And there was no posh background. And so I think from day one, I felt like I'm an outsider who's got to get by my wits. And that was part of my heritage in a way. And so when I see all of these great investors who are outsiders getting by using their wits, there was something that resonated very deeply with me. And I love the fact that someone like Bill Miller, when I saw him in 2000, everybody, basically Amazon, for example, had just crashed, right? It had been $100 a share. It had crashed to something like $6 a share, maybe $5.50 per share in the weeks after 9/11. And I'm traveling with him in those weeks after 9/11, and Miller has bought 15% of the company. That's an astonishing thing if you think of the balls that requires. And I don't know, I remember going even to an event with Bill Miller where it was a value investing event, and there were all of these people there, like Seth Klum and all of his greatest peers in the value investing community. And I think Bill Ruane was there. And I remember Bruce Greenwald, who's a brilliant value investing professor and guru at Columbia, just pillorying Bill Miller and saying why he was such a moron and how Amazon was going to go bankrupt. And Bill stands up and he explains, well, yeah, there's a chance that I'm going to lose 100% of my money. But I also think if I'm right, I'm going to make 50 times my money. And here we are all these years later. And Bill Miller told me that he's the single largest individual shareholder of Amazon, whose name isn't Bezos. And that's an extraordinary thing, to have the guts to go against the crowd, to question conventional wisdom, to think for yourself in that way. And what I remember saying to Bill, you've got to have so much balls to do what you do. And he said, yeah, but I've also got to be right. And so there's something to me very fascinating about the type of mind that questions conventional opinion, has the nerve to bet on it, and outthinks everyone else. And so to me, one of the great questions is, how can you learn from people like that to think better? And one of the things that Bill said to me at the time is, well, look, there are all of these prejudices, these biases at work against Amazon. So, for example, at the time, it was a money-losing business run by a young guy, Bezos, who was a billionaire. The tech bubble has just burst, so everyone's lost lots of money. And they all look at this and they think, well, this is just another company that's lost us tons of money. It's never going to make any money. It's just stupid. And everyone felt burned. And he said, no, if you understand what's really going on here, if you look at the deep reality of Amazon, you can see that there's a misperception here. So he said, what's really going on is, here's a company that has no really expensive bookstores. In those days, it was really just in the book business. It doesn't have all of those expensive bookstores. They just have all of the books socked away in their warehouses. So they have a cost advantage. But the cost advantage is obscured by the fact that they're losing money at the moment. But eventually, that cost advantage will become apparent. And so when he explained this to me, he said, I'm obsessed with philosophers like Wittgenstein and William James, who are talking about misperception. And so part of his influence in buying Amazon and investing at the time $500 million in Amazon was literally this great philosopher, William James, who talked about why we misperceive things, why we're biased and misperceive things. So to me, it was a very beautiful example of how you want to learn not only to invest more wisely, but to look at your own biases and saying, what am I missing because I'm prejudiced? And just to be aware of the fact that we filter everything. And so we don't see the world clearly. And so we need to be a little more humble in our approach to life and try to be more rational. And if you're one of those people who questions what the crowd believes and looks at things in this kind of dispassionate, rational way, but also with humility of saying, I don't know, I can be wrong too, it's an enormous advantage. And I think that's, when I first saw that in Bill Miller, I just thought, this is the coolest thing. This is a guy who just has such a wonderful temperament and such a thrilling mind, and this ability to go against the crowd and question everything. And then at the same time, during the financial crisis, he did the same thing. He was totally contrarian, went against everyone and was wrong and got crushed. And then in recent years, he's gone against the crowd again. He's making a fortune in Bitcoin, which all these guys like Buffett and Munger, who are geniuses, who he admires tremendously, regard as rat poison. So it's fascinating. It's such a rich and intellectually challenging area, but it gets at all of these questions of how can I see more rationally, and how can I detach myself from the crowd and see more rationally. And so one of the takeaways for your listeners is to ask yourself, am I tribal? Am I someone who finds comfort in the herd, or am I comfortable questioning what the herd does and going away from the herd? And there's no shame in the answer, but you have to be self-aware about this, because I think if you go with the herd, it's very difficult to be a good contrarian value investor. You know, you're better off just owning an index fund and riding the market and taking advantage of the wisdom of crowds over many years. And that's a very, very good default position. So there's no right answer or wrong answer here. But I think you have to ask yourself, am I tribal or not?
Yeah. So I guess for our audience, the most complicated for an individual is most times to stay rational. Because as you mentioned, there are so many narratives, and to get footprint in an industry on a topic, that's really challenging. And as Graham always said, be in your circle of competence. I guess that's very, very important.
Yeah, one of the great lessons that I learned from Ed Thorp as well, who's one of the greatest investors of all time, one of the greatest gamblers of all time, is you want to play games that you can win. And so Thorp said to me, Thorp famously figured out how to beat the market, how to beat the casino at blackjack, and then how to beat the casino at roulette. And then he creates this hedge fund that didn't have a losing quarter in 20 years. And he said to me, look, if I don't have an edge, I don't play. And that's really important to know that you want to play games that you can win. And so for me to look at the stock market and say, well, I'm not tribal. I don't, as a writer, I'm a natural outsider. I'm a Jewish writer with a birthmark on my face. I was born to be an outsider, right? So I'm never going to be tribal. So I've got that, but I'm not particularly rational. I don't like valuing businesses. I don't really have the skills to value a business. I don't really have the patience to do it. So it's not really a game that I can win picking individual stocks. I'm not suited for that game. I am probably suited to the game of buying actively managed funds run by really, really smart people, because I know a lot of them. I see what traits they need. I have good access to people like that. And I am profoundly contrarian. So it's easy for me to invest at times when most people don't want to invest, at times when the market's being hit. So that's a game that I can win. Then another game I can win is reporting and writing and sharing those ideas. Like that's a game I'm set up to win. So I want to tilt my life in general towards games that I can win. And so again, if there's a lesson for your listeners, it's to say, what games am I wired to win? Where do I have an advantage in terms of my talent, in terms of my temperament? As Munger says, if you're 5'3", the chances are you shouldn't become a professional basketball player. And just this idea of understanding what matters most to you and what you're best at, and then playing that game, and then learning continuously to become better within that narrow field. That's a powerful idea. And when I look at people like Bill Miller or Charlie Munger or Monish Pabrai, these are people who they have this kind of this tremendous grasp of what they're good at and what they're interested in. And then they just keep, so there's a kind of narrowness and a depth at the same time, where they just keep getting better within that limited sphere. And then everything else kind of gets pushed to the side.
Yeah, that's really a good bridge to my next question. Business schools teach the efficient market hypothesis from Eugene Farmer, for example. The hypothesis implies that asset prices reflect all available information. Therefore, you can't beat the market. That's the theory. Due to Dalbar research, the majority of the market participants tend to operate on this thesis, with the outcome that they achieve average returns below their benchmark index. The masterminds in investing in your book don't believe in this theory. They all find ways to get an edge in this shark pool with mostly easy principles and methods. Can you give us some examples on how your interview partners get an edge in investing, and how did they strengthen these competitive advantage over a long period? What can we learn from them?
Sure. One of the most interesting images that I've ever come across about investing comes from Munger. And for me, this has been hugely clarifying. So Munger says that the great investors are basically like spear fishermen. And what you want to do is be a spear fisherman sitting by the side of the stream and just watching quietly. And then once in a while, a fat, juicy salmon swims by and you spear the salmon, and then you go back to doing nothing. And it might be 6 months before another salmon swims by. And this is a beautiful analogy for how to invest, or at least one of the paths up the mountain, because there are several paths up the mountain. There are multiple ways to win this game. But when I look at the model that people like Buffett and Munger and Joel Greenblatt and Monish Pabrai have shown us, it's to say there aren't that many fat, juicy salmons coming by. And you don't want to be betting the whole time. You don't want lots of small positions in companies you don't understand. You don't want to be trading frequently. What you want to be is this spear fisherman waiting for these moments where the market presents you with what Munger calls a mispriced gamble. And then you spear it with what he calls gumption. And then you sit on it for many years. Typically, you don't want to be trading in and out. You grab these big opportunities and then you hold them for a long time, which keeps your costs down. It keeps your taxes down. And if you're smart enough to find these winners, these mispriced gambles at low prices, then you really want to ride them for a long time because they compound. And what most people do is they trade in and out. They have too many positions and they're too impatient. So they sell their winners too quickly. And so I think it's really helpful to know that this is one of the most powerful models for how to invest, but it's also difficult and very few people can pull it off. So I have no doubt that there are a handful of people reading my book who are going to see this method for how to win the game, and they're going to end up becoming billionaires, right? They see it just instantly makes sense. It's like, yeah, the market is overall relatively efficient, right? There are lots of people buying stocks all the time. The information is out there, and the opportunities get arbitraged away pretty quickly. So you shouldn't expect too many opportunities, but once in a while, the market goes crazy. And those are the moments that you want to take advantage of. And this all goes back to this beautiful observation from Ben Graham, Buffett's teacher, who talked about Mr. Market as this irrational character who basically misprices assets, and he keeps quoting you prices every day for this asset. And most of the time, you just say, yeah, no, thanks. I don't want to buy. I don't want to sell. And then once in a while, he goes nuts and he presents you with this incredible opportunity. And that's when you have to act. So most of the time, you want to be sitting doing nothing. And you just want to hold your investments, let it ride, don't do anything crazy. Then there are these moments of, it's saying that the art of investing are long periods of tremendous inaction where you're just reading, you're studying, you're learning continuously, you're studying lots of companies. And then these long periods of inactivity are punctuated with these bursts of tremendous activity. So you look at someone like Monish Pabrai, who I write about in the first chapter of my book, and he said, look, if you reverse engineer Buffett and Munger, you see the laws of investing, and they're as fundamental as the laws of physics. And you see that most people are just not playing this game by these rules. And so as Monish said, they're all hosed because they're trading too often. They're buying stocks that are overpriced. They don't stand a chance. And so this method of concentrated investing, of concentrating on a few really good ideas that arise infrequently and then holding them for a long time, I think is an extraordinarily powerful model. But most of us can't do it. And so again, you need to be self-aware. You need to say, am I qualified to play this game? Do I have the patience? Do I have the temperament? Can I hold on to winners? And so one thing I've done, I own 3 actively managed funds. And so 2 of them very much follow this model. One of them owns maybe 10 stocks, 12 stocks. It is run by a very patient guy who doesn't pay attention to the market. He's just looking for a few mispriced bets. Then he owns them for a long time. So he has a better temperament than I do. And then I own a couple of index funds as well, because I understand that I'm unlikely to beat the market and that I want to ride the market over the long term. and also not have my wife and children suffer for the fact that I delude myself into thinking that I can beat the market. So I'm kind of hedging my bets. I index because I understand how difficult this game is to win, especially after expenses and after taxes. But then at the margins, and actually not even really at the margins, I have a pretty significant chunk of my investments in actively managed funds, but not too many of them, because then you're really just recreating an index fund, but with higher expenses. So it's difficult. As Charlie Munger says, if this were easy, everyone would do it. And he says anyone who thinks investing is easy is stupid. And so it's hard to play this game. But I think that's one of the greatest ways to beat the market, is to have a concentrated portfolio where you wait patiently for the juicy salmon. Another really important point that I'll just make quickly is that what Howard Marks has done. Howard, as many of your listeners will know, is a multi-billionaire who's overseeing something like $140 billion at Oaktree. He realized very early on that the idea that markets are efficient is a very powerful idea. And it's not entirely true, but it's almost true. And so what he decided is, well, I'd better fish in ponds where nobody else is fishing. And so he looked for parts of the market that were relatively inefficient. And so the parts of the market where he specialized were, for example, distressed debt. So areas where it was hard to understand, it was opaque. Most people don't want to bet on companies that seem to be going bankrupt. It's tough. And so there's less competition. And so I think that gives you another sense of how to win the game, is to fish in an area where you're not up, where there are a lot of fish and you're not up against a lot of competition. And so that gives you a sense of a couple of ways to win this game.
Yeah, as you mentioned, I guess we have to understand the difference between investing and, on the other hand, speculation. And I guess the border to speculation is not very high. And as Buffett always says, know what you own. Yeah, that's very, very important at the end.
Yeah, and Templeton said to me very early on when I was asking him how to invest, he said, first thing, avoid emotion. He said the thing that gets people in trouble is their emotion. They get carried away when things are hot and exciting, and then they get fearful when everything's falling apart. So you have to keep your emotions in check, which for most people is not possible, especially in these extreme periods. And so just to know how you're wired emotionally, and then to find money managers, if you're going to outsource this to an active fund manager, to find a money manager who has a really good temperament, that's really key. And so one of the people I invest with, he meditates every day, takes it really seriously. And that was one of the reasons why I invest with him, because I know that he's got this kind of internal calm. He's got a very calm manner. The second thing Templeton said to me is the other thing that gets people in trouble is just ignorance. He said they invest in things they don't understand. And he said, whenever you're buying something, there's someone on the other side of the deal. And so if they know more than you, they're likely to win. And so you're staying away from both your emotion and your ignorance. And that gives you a tremendous advantage.
Yeah. So let's just talk about the topic risk. So that's my next question. Benjamin Graham developed the concept of the margin of safety in 1934 to reduce risk. You should buy an asset only if the current market price is significantly below the intrinsic value of the underlying business. This concept belongs to the so-called value investors, which are a minority in the investment field. The finance industry, on the other hand, tend mostly to the concept of diversification, which splits your money on several uncorrelated investments, with no specific valuation of the underlying asset. What have you learned from your interviews how the greatest investors define risk, and how do they try to avoid bigger mistakes of losing money?
I think the first thing that all of the great investors I've interviewed would agree on, I think, is risk is not really about volatility, which is how a lot of academics might regard it. It doesn't really matter whether your portfolio is going like that, unless you have to sell, unless you're forced out of the market because you have too much debt or too much leverage or you're living beyond your means. So the volatility doesn't actually matter. What really matters is permanent loss of capital. You don't want to be in a situation where you make such a dumb mistake or you're so unlucky that you suffer from a permanent loss of capital. And so one of the people I interviewed was Irving Kahn, who died at the age of 109 and had been Ben Graham's teaching assistant and was mentored by Ben Graham. And he started investing, I think, in 1928 and, spent something like 90 years in the market. So, it's an incredibly long life. And when I asked him about the secret of investing, he said that the first thing is just to focus on safety. It's always focusing on your downside risk. It's always asking, how much can I lose? And so he said, if you actually focus on avoiding big mistakes, you're going to end up outperforming all of your speculator friends. So your speculator friends are going to be, rolling the dice all of the time. And sometimes they'll have a big score, but in the end, they're going to get hurt unless they're astonishingly lucky. And so focusing first on this question of what's the downside it's such a profound and simple idea. And I think I interviewed this guy, Jeffrey Gundlach, who's a multi-billionaire who I don't write about much in the book, but who's a very remarkable guy. And he said to me, make your mistakes non-fatal. And he said, if you want to survive both in markets and life, your mistakes have to be non-fatal. And so he said to me, I'm wrong about a third of the time. And Gundlach's brilliant, right? I mean, he's a very, very highly intelligent guy, but even he is wrong a third of the time. Templeton said the same thing, that he was wrong about a third of the time. So what Gundlach said to me is, what I always ask is, what's the consequence if I'm wrong? And that's such a profoundly important question, both in markets and life, to say, let's say I'm deluding myself, given that we know most people delude themselves, or that they're ignorant or they're over-emotional, at least on certain occasions. If you say to yourself, what's the consequence if I'm wrong? That applies to everything from driving when you've had 2 or 3 glasses of wine and you're not sure whether you're sober or not, to saying, I'm going to accuse this person of something where I'm not sure whether I'm right to accuse them, or investing money that you can't afford to lose. And so I think that's one of the most helpful practical questions that I can think of, both in markets and life. And then I would also say, when I was writing about Howard Marks, he listed a bunch of ways not to overreach that I think are hugely important. That if anyone reads my book, I think you should pay real attention to what Marx says about ways in which you survive, ways of not overreaching. So one of the things he says is the most basic question is, are you trying to maximize? Are you trying to get the biggest return? Or are you saying, well, the world is an uncertain place. Strange things happen. Sometimes things go against you, even though you've done all of the work and you're pretty certain of what you believe in. And so just be careful. Don't overreach. Live within your means. Don't have very high recurring expenses that could come back and haunt you. Be humble about what you don't know. And so I think that temperament of just accepting the limits of our knowledge is very important. And I re-interviewed Howard during the COVID crisis. I guess it's probably 2, 3, 4 months into the COVID crisis. And he said to me, sometimes it's not just that we don't know what the future will hold. Sometimes we don't even know what the future could hold. And COVID was a pretty good example of that. We all had a sense that a pandemic could come one day. We'd all read about this. I used to edit the international editions of Time magazine, and I did multiple cover stories on precisely this issue. We all had a sense that a pandemic could come. but we didn't really have any idea that it could close down the entire economy, change all of our work habits, keep us all at home, keep us away from our families, change everything about how we operate and about how many industries operate. And so just to have that humility to say, the world is an uncertain place, so let me set myself up in a humble way so I'm not overreaching. And let me look at my exposure to risk. So instead of focusing on maximizing how much you're going to make, especially in heady times like this where people get carried away, ask yourself, where am I fragile? And how can I reduce my fragility? And so it's all about exposure to risk. So you're not just looking back at your experience of the recent past and saying, well, the stock market always goes up and the world does well. And even when terrible things like pandemics and financial crises happen, the market still goes up. It's like, yeah, maybe that's our experience of the recent past, but we don't know. There are different periods. And so set yourself up to try to be less fragile. And I think part of that is about not overreaching. And so while many people are playing the investing game by this kind of horse race of how can I beat the market? How can I make as much as I can? How can I get a newer Ferrari or whatever? I think this focus on becoming a more resilient investor, building a more resilient life and a more resilient portfolio is a really helpful focus. And I've written about that a lot in my book because maybe it's an admission that it's just too difficult to beat the market. Maybe it's an admission of defeat and I'm reframing the question. But I also think when you look at people like Irving Kahn, who lived to 109, it didn't matter whether he made 10% a year, 12% a year, 13% a year. He had enough. He bought everything that he wanted. He had independence. He had a good life. He didn't need to overreach. He needed to survive and to get to the finish line in a safe and happy way. And so that focus on resilience, survival, longevity, avoidance of stupidity, avoidance of catastrophe is incredibly helpful.
Yeah, thank you for these insights. So due to Mohnish Pabrai, I guess he's also a friend of yourself, there's a gold nugget in your book. Mohnish Pabrai, I guess you dedicated a chapter in your book, I guess chapter 1 in your book, The Man Who Cloned Warren Buffett. But he refers in recent interviews to this gold nugget, which should be in chapter 6, Nick and Zach's Excellent Adventure. Can you tell us more about this extraordinary chapter and the super investor behind the story?
Yeah, this has been fascinating to me that in some ways, I think the chapter that's had the most impact on many readers has been one that I didn't really know if I should write this whole chapter devoting it to these two guys because they were almost unknown and they had closed their fund several years ago. It reached something like $3.5 billion in assets and they returned all of the money, retired at the age of 45 and decided we're going to spend the second half of our lives giving back the money to society in the best possible way to create the most good. And so it was a little bit of a gamble for me to write about these two unknown guys. Their names are Nick Sleep and Case Zakaria, who goes by the nickname Zach. And Nick and Zach are these fascinating characters, and they had never spoken to the press before. And thanks actually to Monish's friend and my friend, Guy Spear. Guy introduced me to Nick, and I initially went to speak to him to give him advice on something that he had been writing. And we just kind of became friendly and we kept chatting. And I think because he trusted me, he opened up in a way that he never had with any writer. And then at a certain point, Zach came and met me as well. And Zach was even less inclined to talk to any writer ever. So it was this amazing thing where I got to say, okay, here are these guys who beat the market over 13 years by 804 percentage points, this stunning margin of victory, then closed their fund and decided to return all the money to society, or at least most of the money to society. So what I set out to do was to explain how they did it, how they beat the market by so much, how different their approach was to the approach that everyone else takes. And it became this kind of beautiful morality tale in which the good guys win, because so much of Wall Street is directed towards short-termism, maximizing its own profits at the expense of customers. And here were these two guys who were incredibly idealistic. And so part of what happened is that Nick, when he was maybe 19 or so, had read this very eccentric novel come memoir by Robert Pirsig, which is called Zen and the Art of Motorcycle Maintenance. And Pirsig, who is this sort of very eccentric philosopher and author and memoirist, became obsessed with this notion of quality. And what he said is that everything, whether you're mending a dress or sharpening a knife or being a philosopher or a writer, everything reflects these inner qualities of, for example, peacefulness or patience or calm or kindness or dedication to quality, or it reflects these ways in which you're falling away from quality. So it's all about, are you doing things with quality or not? And so Nick and Zach became obsessed with this idea, and they thought, so how do you run a fund that's dedicated to quality? And so one of the things that they did is they really decided not to screw their shareholders. And so they kept changing the fee structure. So it became worse and worse for Nick and Zach and better for the shareholders. Another thing they did is they said, everybody else is so obsessed with short-term information, with perishable information. So if you think of most people on Wall Street and most investors, they're reading the news every day. They're bombarded by information on their Bloomberg terminal, flashing in multiple colors, saying, this is happening to this stock, and this is happening to this company, and this is happening to the economy. And as Guy Spears said to me once, all of these things, they're calls to action. And if you're a brokerage firm, you profit from calls to action. You're trying to get everyone to trade more, to do more. Every time they do more, you get a commission. And then likewise, if you're a financial consultant, you're paid to advise big institutions, big foundations to do more, to tweak your portfolio in this way because the Sortino ratio is this and this ratio is this. You know, that and Buffett always mocks these guys as hyper helpers, right? So you're paying all of these helpers who are getting you to tweak everything, do more, act more. And what Nick and Zach figured out is, no, we're going to do exactly the opposite. We're going to get rid of all of that nonsense that the rest of Wall Street is obsessed with. So they refused to take any calls from Wall Street banks. They didn't take any. They would just tip all of these brokerage reports into the trash every few weeks. They never read anything, and they just did their own work. And so they would just research lots and lots of companies. They traveled constantly. And so they're just building this kind of database in their minds of all of the best companies, all of the best models. And then they would make a series of very, very large concentrated bets on the best companies, and they would hold them for many years. So they were setting themselves up in a way that was totally countercultural. They were much more like the spear fishermen we were discussing before. And what they figured out gradually is that there was one business model that was better than all of the rest. And that was what they called scale economies shared. And so they, like Bill Miller, zeroed in on Amazon very early. They bought it a little after Bill, but they bought it when it was around $30, $35 a share. And they've owned it for 16 years, massively, never sold it. At one point, their individual net worth, they had more than 70% of their own money personally in that one stock. And what they figured out, it was based on what Costco had done, which is that, so they've also owned Costco for about 18 years personally, and it's one of their favorite businesses. And what Costco did is they just took incredible care of the customer. And so I think their markup for everything was 14%, something like that. And so because they treat their customers incredibly well, the more money Costco made, the more they would just kind of pump back rewards to their customers. So they got all of these benefits of scale as they grew. Their revenues would increase, then they would cut costs more, and they would just give a better and better deal to their customers. And so their size, instead of becoming an anchor, became a benefit. It became powerful. It became this kind of virtuous cycle. And so what Nick and Zach realized when they saw Amazon is, oh, it's doing the same thing as Costco, but it's, as Nick said, it's Costco on steroids. So here was Amazon just making life more efficient and cheaper for its customers. And so when Amazon Prime started, it's like, oh, we'll give our customers free photos. Oh, we'll give them free TV. We'll give them free films. We'll give them free storage of their photos. And so it was just like Amazon constantly taking these benefits of scale and pushing it back to their customer. And so I think because Nick and Zach were so focused on just reading, thinking, traveling to visit companies and thinking for themselves, they were able to cut through all of the noise and figure out, oh, there's this business model that's just superior. And so if you look at their stock portfolios now, Nick has most of his money in just 3 stocks. I mean, it's 4 now, but he still owns Berkshire Hathaway, Amazon, and Costco are his main holdings. And that's a really interesting counterexample to the way that most funds operate and most people invest. These were guys who were reducing noise, reducing short-termism. They weren't focusing on all of this perishable information. What they were focusing on was what Nick calls information with a long shelf life. And so instead of fixating on, is this company going to do well over the next quarter? Is it going to beat analyst estimates for next year? They were asking much more profound and fundamental questions. And so they did what they call destination analysis. And so Nick would say, what's the destination? What's a desirable destination for this business? What's Costco trying to become? What's Amazon trying to become? And are they creating the inputs to reach this desirable destination? So are they treating their customers well? Are they making their customers' lives better? Are they screwing their shareholders? Are they screwing their suppliers? How are they behaving? And so this is a totally different approach to life. Instead of this kind of very short-term approach, you're looking at the long-term destination and then working backwards and saying, is the behavior going to get you to that desirable destination? And one of the things that I mentioned just briefly in my chapter about them, but which I think is an incredibly important and practical idea, is that you can apply destination analysis in your own life. So you can say, what's a desirable destination in my life? How and the ultimate destination, right, presumably is either there's an afterlife or we're in the grave and people come to our funeral and they talk about us and they either look back on us with love and affection and they remember us for what we did in the world, or they look back and they say, yeah, that guy wasn't so great, good riddance to him. And so when you think in terms of your own life, you think in terms of the destination and then you work backwards and you say, what are the inputs that will get me there? If I want to be remembered by my wife and kids and friends with love and affection, how do I need to behave? It's an incredibly important way to think. And if you look also at the businesses you're investing in, are they behaving in a way that's honorable, that's admirable, that's sustainable? Are they thinking long-term? Are they allocating capital in a long-term way? Are they rational? It totally changes the way you think. And so few people are operating in this rational long-term way that it's a tremendous competitive advantage if you think this way. And so I ended up really regarding this chapter as a sort of, it's almost philosophical. I mean, it's saying there's a different way to live and to think, that in a world that's becoming increasingly short-term, if you can think in a long-term way, if you can think about destinations and how to get there, and you can cut out all of the noise and short-termism, all of the stimuli that are making you act impetuously and irrationally, it's a tremendous competitive advantage. And this turns out to be the case not only in investing, but in every area of life. So if you think about the ways that we screw up in our day-to-day lives, it tends to be all of these short-term decisions where we're wired to want this instant hit of dopamine, right? Let me check my Twitter notifications. Let me check how many people have liked this thing that I posted on Facebook. Let me get the fourth piece of toast because it makes me feel good and I'm enjoying it already. We're constantly drawn to the instant hit of dopamine. And so this becomes a kind of master principle in life. If you can say, no, I need to defer gratification. I need to focus on the long term. I need to focus on the destination. It's very clarifying because it makes you understand, oh, that's why you save for the future. That's why you live within your means. That's why you invest in a long-term way. That's why you don't go screw around with, other women, or you don't go steal something, or you don't cheat on your taxes. It's like, these are bad bets, right? They're ways in which you're, as Nick Sleep said to me, you're borrowing from the future. And so just to understand that this is one of the principles of life, one of the ways in which the universe works, is incredibly powerful because it clarifies everything. And it's still hard to do. It's not easy to defer gratification, and some people are wired better for it than others. But I think just understanding that there's this tension between this tremendous kind of almost physical yearning to get the hit of dopamine now, and to trade now, to do more now, to focus on the thing that you shouldn't do, and this longer term benefit of, let me just shift my focus towards the long term, and am I creating the inputs that will get me to the long term? That affects everything from how you exercise, to how you eat, to how you treat your wife and kids, how you behave with your friends, how you behave with your business partner. And so this is, to me, a very profound example of how being a smart investor is not any different than being a smart businessman, being a smart human being, being a wise person. And that in some ways, in all of these areas, you're stacking the odds in your favor to have success both in markets and life. And so I'm in writing about the great investors, I'm not saying, oh, these guys are billionaires, so they must be happy. That's not what I'm saying at all. I'm saying that they give you clues about how to operate in a rational way that stacks the odds in your favor. And one of the most powerful ways you can act is to say, let me defer gratification. Let me think about the destination and whether I'm behaving in ways that are going to get me to that destination.
Yeah, getting your dopamine under control, I guess that's key at the end. And Nick Sleep is a good example on that. You have to be a business-driven investor. And as we all know, a company needs time for value creation. It's not driven from quarter to quarter. So at the end, sometimes also the jockey is very important, like Jeff Bezos from Amazon. And the key is at the end, I guess, also for our audience, be a business-driven investor with a long-term focus.
And partner with people who think this way. Because if you partner with people who are short-term, they're going to make dumb decisions because they're trying to line their pockets now, or they're worried about what's going to happen next quarter or next year. And what you really want to do is partner with people like Warren Buffett, Jeff Bezos, who think in a long-term way, who are trying to create value in the long term. And you want to approach your own life in that way as well. Like, what do I want my life to look like in 5 years, 10 years, 15 years? And if you, 20 years, 30 years, 50 years, and if you behave in a short-term way, are you getting yourself closer or further away to that desirable long-term destination?
Yeah. So I just have a special question for you, because it belongs to all the great investors you have interviewed in the past. Most of these investors in your book are in the late phase of their life, and some are already passed away, like John Templeton. Therefore, we could think that they have made their success in times which are not comparable with these times. Business and finance transition due to digitalization and artificial intelligence generates nowadays an environment with less companies and a handful of super enterprises like Apple, Amazon, Alibaba, Facebook, and Google. It seems there are less opportunities which are more driven by AI and passive investing. With your background, William, on hundreds of hours discussing with the greatest minds in investing, do you believe these success stories are unique and not repeatable in our fast-changing world?
It's a great question, and one that none of us really can answer. And I remember Bill Miller once saying to me that the biggest problem in markets is that everything changes, that nothing stays the same. And so something that works for a while may cease to work. And that's an incredible challenge. And if you look even at many of the best investors, they'll beat the market for many years, and then they'll cease to beat the market. And over the long term, it's so difficult to beat the market because of taxes, expenses. And so I think you need to be humble, and you need to say, well, I know that this is going to be really tough. I know that the markets are becoming very efficient. I've got to keep my expenses down. I've got to be really wise about taxes and the like, because it's your after-tax returns, your after-expense returns that really count. And given how difficult it is to beat the market, even by 1 percentage point, 2, 3 percentage points, incredibly hard over time. So keep your costs down. The costs really matter. Then I think you have to say the default position is probably to index, and it's a really smart thing to index. But having said that, the markets are driven by human behavior, by greed and fear. And as Howard Marks taught me, it's very helpful to see the markets as a kind of pendulum, that things swing from one extreme to the other because there's fear and greed. There are, lending standards change, right? People become like too loose and exuberant in lending to anyone who doesn't have a job or doesn't have good collateral. And then it swings back, as it did after, say, 2008, 2009. And suddenly the banks, the lenders, they're all really tight. They won't lend to anyone. It becomes really tough. So everything functions in this way where it oscillates. It's a pendulum. And that creates a tremendous advantage if you're rational, if you're the spear fisherman, if you detach from the crowd and you say, okay, I'm going to operate in a counter-cyclical way. So when everyone else is being an idiot and is being irrational and is taking too much risk, I'm going to drive a little more carefully. I don't know what the future holds, but I need to drive as if I'm driving in fog on a really icy road. So I need to drive more carefully. And then when everything falls apart and the market is crashing and everyone else is panicking, this is the moment when you seize opportunity. And so if you can set yourself up in a way to take advantage of other people's ignorance, irrationality, and emotion, you're likely to do well. Because I don't think, however much the world is being changed and markets are being changed by machines, it's still going to be driven by human emotion. There is still going to be these moments of excess on either side of the spectrum, whether it's too much euphoria or too much despair. And so because we haven't repealed those excesses in human behavior, because those things are perennial, they're built into our wiring. If you can be more long-term, more rational, I think there's tremendous opportunity. But I think you have to say, am I wired to win that game? Am I rational? Am I dispassionate? Do I have my emotions under control? Do I have an approach that fundamentally makes sense over the long term? And part of what's so difficult, and I write about this a lot in my chapter about Joel Greenblatt, is that even the best investors are out of favor for several years. And so if your approach ceases to work for several years, you don't really know if the paradigm has just changed and your way of investing no longer works. It's been arbitraged away. Or is this just another swing in the pendulum? And eventually it's going to become logical again and rational again, and I'm going to do well. And that's what's so hard. You have to not only have good principles, but believe in them so deeply that you can hold them through thick and thin, even when they're not working for several years. And that's tough. That's really tough. And then to go back to what Bill Miller said before, you not only have to have the balls to do that, to go against the crowd, you got to be right. And so, as Munger said, this is not an easy game. And you're up against the best minds in the world because it's such a great game that you're drawing a lot of great competition. And so I'm not trying to be discouraging to people. I think there are enormous rewards if you're good at this. But I think I'm self-aware enough to know that I'm unlikely to win by picking stocks myself. And so a combination of investing passively in, a Vanguard International Fund and a Vanguard Total Stock Market Index Fund, and accepting the fact that I'm going to find it really hard to beat them, given that their expenses are something like 0.14 percentage points a year. I mean, it's so hard to beat that after tax. So just to know that that's a good way to play the game. And then if I want to play around at the margins, fine. But start with that position of humility.
So, William, that was a really great summary on what's key and what is really important at the end. But I've got one bonus question. With your life experience, what would you recommend to your younger William Green, how to become a better of yourself and how to start investing? If we start with investing, which is probably the easier question, one of the great lessons that I've learned is the stupidity of the times when I overreached and I was in a hurry and I got jealous of other people. And so I saw other people doing really smart stuff that made them rich in a hurry. And I thought, oh, I want a piece of that. And so I had access, because I have good friends who are working at places like Goldman Sachs and stuff. I had access to some really interesting deals where there were private companies that I could get into, and I could see how much money people were making in venture capital, and I thought, and it appealed to my ego. So I thought, okay, so because I'm so special and I have all of these great friends and I'm a journalist and I know all of these people, I can get access to this great stuff that nobody else can. And so it really appealed to my ego. And almost without exception, those things turned out to be a disaster. And not only did I lose money, I lost almost all of the money that I invested in those things. And A, it wasn't a game that I was really equipped to win. B, it appealed to my ego and my vanity in a way that was really dangerous. C, those are areas where in venture capital, you need to make a lot of bets, I think. And if you're lucky, one or two of them work out fabulously. And I was doing 2, 3, 4 things. I didn't necessarily have, so I wasn't diversified enough. And I didn't have good enough judgment or knowledge really to know what I was doing. It wasn't like I was from Sequoia Capital and I had the access to the very best deals, the very best companies, and the expertise to analyze them. And so it was a game I wasn't really equipped to win. And without wanting to be too self-referential here, I think in investing, you have to really keep your ego in check and not overreach. And the things where I've done best were the things where I was really rational. And I just said, okay, I can see that this person has a really good investment process. The expenses are low. They treat you honestly. They're not gouging you. It's very transparent. They have their own money in the fund, all of their money in the fund. So our interests are aligned, and I'll just stick with it for many years. So for example, something like my friend Guy Spear, who I helped write his memoir, The Educational Value Investor. I've invested in Guy's fund for 20 years. That's like a really patient investment that's quietly done well, that's quietly beaten the market by a small margin over 20 years, despite years of underperformance
it sort of, in the end, it outperforms. And I've just kept rolling. And I've said to Guy, this is a 40-year investment for me. And so something like that, where you're much more patient, you're not trying to hit the ball out of the park. You're riding the market up with, he has very reasonable expenses, right? The fees are honorable and it's kind of transparent. So getting those big things right, it wasn't the really bold, ballsy stuff that mattered. It was the small stuff, like, are the expenses low? Is the manager treating you honorably? Which is usually something you can tell just from their fee structure. Do they admit in their shareholder letters to the mistakes they've made? Are they humble? Are they transparent about their process? Things like that matter enormously. So if you get the big things right, like putting your money in tax-advantaged vehicles, whether it's an IRA or 401k, 529 plan, whatever it is in your country, that's really key, right? You keep the taxes down, you keep the expenses down, and you ride the long-term growth of the market. So getting the big things right turns out to be critically important. It's not the rolling the dice that helps. It's the low expenses, the low taxes, and not selling out at bad moments, adding at bad moments when the market's disrupted, and staying in the game for a long period. And the trouble is that we tend not to see the benefits of that kind of rational, sustainable, sensible, long-term behavior for decades. And so it's almost a leap of faith to understand, oh, that's going to really work, and to behave. And so not to gamble in ways where it's like, no, I could make $1 million over the next 3 years because I put $10,000 in this company or I just bet on this cryptocurrency. And that stuff gives you those instant hits of dopamine. But what's actually really, on the whole, overwhelmingly powerful is this sort of steady, sustainable, long-term rational behavior. And that's been a huge lesson, that I didn't need to take the kind of stupid risks that I was taking. I needed to be sensible. So that's a long-winded answer to the question about investing, but I think it's actually an important one. The other thing I would say is focus on other things that compound. It's not just money that compounds. And one of the things that I learned from Guy Spear, he talks about this idea of compounding goodwill. And so if you act in a way where you're constantly acting decently and honorably and kindly and generously to other people, you draw incredible people into your life. And so the quality of your business partners, your friends, your relationships with your family, all of these things, just they're so much better. They're so much sweeter than if you behave in this short-term way where you're kind of sharp-elbowed and you're thinking, how can I get the better of this guy who I'm doing a deal with? How can I squeeze a little bit more out of my shareholders? How can I maximize my profits now at somebody else's expense? Or how can I say something that's like a little bit snarky that makes me look smarter and superior, but hurts this other person? And so just that understanding that your own behavior, the results of that behavior compounds. And so when you focus on things like compounding kindness and goodwill, it's not just a sort of do-gooder, self-righteous thing where it's like, oh, look what a wonderful person you are. It's like, no, you draw much better people into your life and your relationships become better. Likewise, you feel better about yourself. And similarly, when you're trying to compound, focus on the compounding of good habits. So when you look at people like Buffett and Munger, they've been reading books constantly for decades. Think about that idea of continuous learning, continuous self-improvement. So I write about this in a chapter on high performance habits. And I talk a lot about this guy, Tom Gaynor, because he has this wonderful idea of just picking habits that are directionally correct. And so you find a few habits that you don't need to be the best at this, but they're directionally correct and they're sustainable. So you think about this with the way you eat, with the way you exercise. Yeah, it would be better if I did more weights and I did more yoga, but at least I get on my bike. I do what I call the tour de laundry room. I have a Peloton next to my washing machine. I mean, it's not exactly glamorous, but if you keep doing that over many years, you're stacking the odds in your favor of having a happier, healthier, and more successful life. It's, again, if you think of the destination, I want to be healthy and happy and flexible when I'm 80, 90 years old. So if that's the destination, what are the inputs I need to get me there? So I've got to keep moving. I've got to meditate because I need peace of mind. And so the benefits of meditation, you're not feeling on that day. Maybe you do a little bit, but it's compounding. The benefits compound. And so your mind becomes calmer, more rational, you're less reactive. And so there are benefits over many years. And so to have this sense that it's not just my money I want to compound good habits. And that if you focus on a few big things like be kinder, be more loving, meditate, so or whatever it is that gives you peace of mind, build good friendships, build good relationships. These are things that, like everything in life, the things that are true tend to be so simple that our eyes glaze over and we dismiss them. But these simple habits of being kinder, exercising, meditating, investing, living within your means, treating people decently, the benefits over many years are so enormous that it kind of overwhelms everything else. And so I think if I wish I'd figured this out earlier. It took me a long time to figure it out, and I still have figured it out pretty imperfectly. But once you start to realize, this is what's really going to shift the needle in my life. It's not going to be how many millions of dollars do you have. I mean, once you're at a certain level where you have some degree of independence and security and comfort, and you can send your kids to the schools they want to go to and whatever, as far as I'm concerned, you're basically done. So that's not what's going to make a difference. What's going to make a difference is the quality of your relationships. Are you hanging out with people you love and who love you back? And so how are you going to behave in ways that are going to build good relationships? And even knowing that that's such a priority has been very, very helpful to me. And that's, curiously, is something that I've learned from the great investors, people like Ed Thorp, the ultimate game player. When I said to him, how do you stack your odds to win the game of life, given that you won at roulette and blackjack and the hedge fund business? What do you do with life? And he said, ultimately, the most important thing is who you spend your time with. And so once you look at someone who's as rational and wise as Ed Thorp, who's probably 86, 87 years old now and has that experience and wealth of wisdom that comes with age, when someone like that tells you, no, who you spend your life with, who you spend your time with is the most important thing, you can say, okay, so why am I focusing so much time on success and money? And so, yeah, that's important. I want to be financially independent, but it's not everything. I want great relationships. And so am I treating my wife and kids and my friends in a way that's likely to build strong, joyful relationships? And so I think one of the things that's interesting to me is that the greatest investors are just these rational pragmatists. They're not super self-righteous about all of these things. They're just saying, as Charlie Munger says, what works and doesn't work and why. And when you look at all of these things, like how to invest, how to live, how to build good relationships, it's not that complicated. It's just understanding a few simple principles. And then, as Charlie Munger would say, take a simple idea and take it seriously. So what I hope people get from my book and also from this discussion, Alex, which I know I'm very long-winded, but I'm happy that you've given me this chance to talk. What I hope people get from it is they come out of it with a few simple ideas where they're like, okay, so that's what all of these guys have figured out works. Let me at least get that big thing right. And when you find something that really resonates with you, where you're like, yeah, pretty sure that's true, at least it's approximately true over time, go big on it. I mean, if you decide that something like compounding goodwill is important, or living within your means, or reducing fragility, or deferring gratification, once you understand the importance of one of these big ideas, take a good idea seriously. This is the difference between us on the whole as relatively successful people and these wildly successful people, is that they're somewhat fanatical when they discover a good idea. When someone like Monish discovers the idea of compounding or the idea of cloning that I write about in the first chapter, he's going to go 1,000% on it. And so I would just encourage your audience that when you find one of these principles that really resonates with you, take it very seriously and make it a core part of how you live your life.
William, there's nothing to add. That's really a great closing. Thank you for this insightful discussion. I recommend our audience to get a copy of this book or the audio file. And thank you very much. I guess this was very much fun for me, for myself, hopefully for you too. And I wish you all the best for the near future.
Thank you so much, Alex. It's been lovely talking to you. Thank you.